All right, let's talk about a really powerful tax deduction that's, kind of hiding in plain sight. It's especially for investors who use leverage, think margin loans. We are going to crack open the secrets of IRS Form 4952.
So, I guess the first question to ask yourself is this: are you missing this hidden tax break? Seriously, because if you have ever borrowed money to invest, there is a very real chance you're leaving a good chunk of money on the table.
So why is this deduction so often overlooked? Well, a lot of it goes back to the 2017 Tax Cuts and Jobs Act. See, that law made the standard deduction so big that for a lot of people, it just didn't make sense to itemize anymore. And when they stopped itemizing, this awesome write-off for investment interest just kind of fell off the radar.
Okay, so how do we get this deduction back on our radar? It all comes down to one simple, absolutely golden rule that the IRS follows. It's called tracing.
This right here, this is the whole ballgame. The IRS basically plays detective. They don't care what you used as collateral to get the loan. You could pledge $1 million in stock or use your house. Doesn't matter. What is absolutely critical is where that money went. Think of it as following the money. If you took that loan and bought a car, nope, that's personal. No deduction. But if you took out a home equity loan and used it to buy more stocks, bingo. That interest is potentially a deductible investment expense. It's always about the use of the funds.
And just so we're crystal clear, let's talk about what's not in the game. The interest you pay on your mortgage, that's got its own lane, its own rules. Interest from a rental property that you're not super involved in, that's a passive activity, also has its own rules. Oh, and this is a big one. Interest on a loan you used to buy tax-free municipal bonds? No way. The IRS says you can't double dip like that. And of course, any personal stuff, car loans, vacations, that's a hard no. This deduction is strictly for interest tied to your taxable investments.
Now, as amazing as this deduction is, it's not a free-for-all. It's not unlimited. There's a ceiling, a cap, and that cap is determined by something called your net investment income.
So, what on earth is net investment income, or NII? The best way to think of it is like a bucket. It's all your gross investment income for the year minus other investment expenses. The amount of income in that bucket is the absolute maximum amount of investment interest you can deduct for the year. The size of your bucket sets your limit. Simple as that.
And here's where it gets really interesting. By default, that bucket is filled with things like regular bank interest and ordinary dividends. But look what's not in there: qualified dividends and long-term capital gains. You know, the stuff that usually gets those nice lower tax rates. This is a super important detail because this is where we get to make a really powerful strategic choice.
And that choice brings us to the most powerful part of this whole thing. I'm talking about the Line 4G election. This isn't just about filling out a form, folks. This is about playing chess with the tax code. This is the pro move. So here's the fundamental trade-off, the decision you have to make. Do you want to keep that sweet, lower tax rate on your qualified dividends and long-term gains? Or would you rather get a bigger, fatter tax deduction right now by giving up that preferential rate on some of that income? That's the question.
Okay, let's make this real. Check out the numbers. In option A, you do nothing. You have 15 grand in qualified dividends and 10 grand in investment interest you paid. But your deduction is zero because you don't have any ordinary investment income to deduct it against. So you pay your 20% tax on the dividends. That's a $3,000 tax bill. Now, watch what happens in option B. You make the election. You tell the IRS, hey, I want to treat 10,000 of my qualified dividends as ordinary income. That fills your NII bucket with 10 grand. Now you can deduct your full $10,000 of interest. It perfectly cancels out. The tax on that portion of your income becomes zero, and you just saved yourself $2,000. It's an amazing bit of tax arbitrage.
But what happens if your interest expense is bigger than your income bucket? What if you can't use it all this year? Does it just vanish? No way. This is where something that sounds like a loss actually turns into a huge future opportunity.
So, the official IRS term for this is disallowed investment interest. It just means any interest expense that's left over after you've hit your net investment income limit for the year. But honestly, don't let that word disallowed scare you. It's a terrible name for what's really happening.
Yeah, because this process, as the source material puts it so perfectly, transforms disallowed interest into a dormant tax asset. I love that phrasing. It's not gone. It's not lost. It's just sleeping. It's a tax deduction that's on hold, waiting for you to activate it in a future year. It's an asset.
Let's see how this actually works. Say in year one, you have 10 grand in interest but no investment income. That $10,000 gets carried forward. In year two, you have another 5 grand in interest, still no income. Now your carryover total is up to $15,000. But then in year 3, you have a fantastic year. You've got $25,000 in net investment income. Now you can deduct not only the $5,000 from this year, but that entire $15,000 you've been carrying forward, a massive $20,000 deduction. And the best part? You can carry this forward indefinitely.
Okay, we've covered a lot of ground. Let's wrap this up and really focus on the biggest traps to avoid and the key things you absolutely need to remember. And first up, a little bonus. For those of you who are higher income earners, this deduction actually does double duty. It doesn't just lower your regular income tax, it also reduces your exposure to that extra 3.8% net investment income tax. It works because the interest expense directly lowers the net investment income number that Surtax is based on. You're hitting 2 different taxes with one single deduction. How cool is that?
Okay, now listen up, because this is probably the biggest, most critical mistake people make. Even if you take the standard deduction and don't itemize, you have to file Form 4952 every single year to keep your carryover alive. If you skip just 1 year, the IRS can argue you broke the chain, and that forever tax asset you've been carefully building up could vanish. Poof, gone. Filing this form every year is non-negotiable.
So when you boil it all down, it comes to 3 simple power moves. Number 1, trace your funds. You have to know what you use that borrowed money for. Number 2, optimize the election. Every year, run the numbers on that 4G trade-off. And number 3, preserve your asset. File Form 4952 every single year. No exceptions.
So, there you have it. You know the rules of the game. You've seen the strategy. The only real question left is, now that you know all this, how are you going to use leverage to make your portfolio more tax efficient?